Alright guys, hi, welcome. Happy Wednesday, AJ here. Another quick video on candlesticks. Another quick video, a video in a series of videos actually on Forex trading. As you know, I'm a Forex trader. I've been doing that for some time now. I have a big community of traders and we just try to educate more people about trading. A lot of people think this is a scam. A lot of people think that it's pyramid scheme, it's this, it's that, and just the truth is they weren't doing enough and they weren't learning enough before they went into live trading. So they didn't practice, they didn't educate themselves. So don't do that. I really do not advise you to do that. It's just a bad thing, right? So you're just discriminating the whole community who makes money because you were ignorant. So just please don't do that. Here I have a free educational platform where you can learn things and I can teach you the basics, and just from those basics you can make a lot of money. Now I do have my students, my personal students in my academy. Well, we of course start with the basics as well, so they have, all of them have already seen this, but just the basics, and you have to start learning how to ride a bike before you can ride a motorcycle, right? So in the previous video, we said that in the market, we can either buy or sell currency pairs, right? And we want to do that when we are in trend, when we can see the clear picture and when we can see where the price wants to go. As we said, we have two kinds of markets. We have the bullish and the bearish markets, which means that the bullish market is an uptrend market and the bearish market is a downtrend market. So that means that the price is either going up in an uptrend or down in a downtrend. Pretty easy things to understand. So guys, there are a lot, and I mean there are hundreds and hundreds of patterns to take a look at, right? So obviously you cannot memorize them all, and you don't have to, because I've gathered 6 types of commonly present candlestick patterns. These are really commonly seen on the charts, and we're going to take a look at the 6 bullish ones and the 6 bearish ones. Like I said, once again, these are really easy to recognize. Their idea is almost the same for all of them. They're just a bit different in their bodies and the way they appear, and they can be really of use when you do your personal analysis. So today, let's just start with the bullish ones, and let's start with their explanations, the idea behind them, the concept behind them, what to do when you see them, how can you even see them on the charts, and how to make a difference between those who look like it and those who are just being a fake out. So we're gonna go not too in depth about these because I do that with my students, obviously. So just for the basics, this one is called Dragonfly Doji, right? It looks like a letter T, pretty simple to understand, and it looks like a letter T because its opening and close price is almost the same. It's almost the same, and you just have a big wick here. Wick, or a shadow, is just an extension to the body where the price went but didn't close at that spot, right? That's a pretty simple concept to understand. And so this thing preceding downtrend, look for at the bottom of the new, we hope, uptrend. What does that even mean? Well, it's pretty simple, right? So we had a downtrend, the price was going down, and then it started ranging, which means that it went up for a bit, then down for a bit, and then up for a bit, and then down for a bit. Basically, it was going sideways, right? And then we see this candle. Now, that means that we could be looking at a reversal. It means we could be looking at a new uptrend. And this is what that means. So we had a downtrend, now it is going sideways, and we see this candle. What do we do then? Well, we wait for the next candle to close above the high of this one. If it does, we open a long position and set a stop loss at the low of the doji. Now, a long position means that we buy. It means that we go in for a buy and we can just secure some profits for that day. The other thing, the hammer, right? The hammer is a candlestick pattern. It's really simply to understand and recognize because it looks like a hammer. So its body is a bit bigger than the body of the doji, but its wick, or its lower shadow, is almost twice the size of the body, right? So I've written down here, no or small upper wick. Now, this just goes to show that people just write this down as a special note. Write this down, what I'm about to say, as a special note. All of these drawings, they are just the simple and basic idea of how these candles look, right? On live charts, when price is going up and down and a lot of things are happening in like split second, obviously they are not gonna look exactly like this. So they are not gonna look exactly like this. But this is the basic idea, and you can use this idea to recognize them on the charts. For in this case, we have the hammer, right? And for the hammer, I said no or small upper wick. The hammer can have a big wick up, right? It can have a big wick up and a small wick down, but it's still going to be the hammer, right? So in that case, we wait for the next candle to close above the high of this one, go in for the buy, open a long position, set a stop loss at the low of the hammer, and once again, secure your bag and make some money. Now, number 3. You want to write this down, you want to draw this down, you want to write this down, you want to remember this so you know it at the top of your mind in the middle of the night, right? So the engulfing, bullish and bearish engulfings are the, let's say, the most secure way to know something is about to happen, right? Because after engulfings, usually 9.9 times out of 10 something happens, right? And what does happen? So in this case, we have the bullish engulfing, which means that the bullish candle can literally eat or absorb the red candle, or in this case, the bearish candle. And on my charts, I have my chart set up as black background. My bullish candles are blue and my bearish candles are red. So in this case, the blue candle can literally eat the red candle, and its body is way bigger than the body of the red candle. Now, keep in mind that the red candle can have long wicks, right? But it's the body that counts. So even if the red candle or the bearish candle, whatever color that may be for you, if it has big up or down wicks, still its body is way smaller than the blue's body. And just the same as everything else, wait for the next candle to close above the high of the bullish one, set a stop loss at the low of the bullish one, or even at the low of the red one if the wick is long down there enough, right? Open long position, secure a bag, make some money, right? So number 4, I think number 4 or 5, we have the piercing. Piercing is pretty easy to understand as well. Basically, we have the bearish one followed by the blue one. So in this case, the composure is very, very important, because we need to have our bearish candles first, and then we need to have our bullish candles, right? So in this case, the bullish candle, right, it closes above 50% of the bearish candle. I have a typo here, sorry, but the bullish candle should close above 50% of the bearish candle. Once again, wait for the next one to close even higher, which could indicate a new uptrend on a smaller or a bigger basis, and therefore we can go in for the long, go in for the buy, and continue to move forward. Right, guys, number 5, tweezers. All right, they are pretty simple to understand as well, because their bodies are almost the same, and their wicks, right, their shadows, their lower shadows in this case, look like they've been cut with a wire, right? So they are pretty almost the same, right? And just as every else, we just wait for the next one to close above the high of the bullish tweezer. We set a stop loss at the low of the bullish tweezer and continue with the long position. Number 6, 3 blue soldiers. All right, this is, I think it's the simplest one, it's the easiest one, because it's literally 3 blue consecutive candles in a row, and you just want to wait for the 4th one to close above the high of the 3rd one, secure the bag, open long position, set a stop loss at the low of the 1st one or the 2nd one, depending on how big they are. But the whole idea is that they are usually almost the same. Maybe the 3rd or the 4th candle could be a so-called a rocket candle, which means that it's way bigger than the previous one. It could be, doesn't happen always, but you could be looking at that as well. All right, so we are done with the bullish candles. Now let's just take a quick look on the bearish ones. Now, just a little note here, I've written down the idea is the same as for the bullish ones, so we're not going to spend a lot of time. We're going to spend maybe half a minute on each one just to see the differences in pictures. But of course, this is a video, so you can stop this and at any time draw them down and just understand the idea behind them and how to recognize them quickly, because as I said, they're not going to be the same as I have draw them right here, but the idea behind them is: number one, the gravestone doji, or just a bearish doji, the same as the dragonfly doji, but over here it looks like an inverted T. And now this preceding uptrend, look for at the top of the new we hope downtrend, it's exactly the same. So we had an uptrend, price now began to move sideways, it began to move in a range, so-called range, or consolidation. That's another term that we traders use to say that the price is just moving sideways. It's not going up, it's not going down. We do not have a clear trend. So we had an uptrend, the price has been sideways, and now the price should go down. And when we see this, we just want to wait for the next candle to close below the low of this one, and we want to set a stop loss at the high of this one, go in short, which means to sell and secure the bag. Shooting star, people, just the same as the hammer, just the exact opposite, like the physical appearance is the exact opposite. And it's called a shooting star because it like represents a meteorite. Let's say that the body of this candle is the meteorite and the wick of the candle is like that, like a trace of fire that is like behind the meteorite. So it's really simple to understand. Upper wick is way bigger than the body. We want to wait for the next one to close below, so the stop loss at the high of this one, and go short. Number three, the most important one, people, you want to remember this one, the bearish engulfing. All right, so we had the bullish one, now we're talking about the bearish engulfing. Literally, the red one can eat the blue one. It's way bigger, it's way thicker, right? And the wicks doesn't matter, only the bodies matter. So just the same as every other, we want to wait for it to close below the low, the next candle to close below the low of the bearish one, set a stop loss at the high of this one, go in short, go in for a sell and make money. Right guys, dark cloud cover, exactly the same like piercing, but here we want our bearish candle to close below the 50% of the bullish one. Again, we want to wait for the next one to close even lower, so it indicates that we might be looking at a new downtrend. Now that downtrend can be a small downtrend or it can be a bigger downtrend, right? Tweezer top, people, just the same as the bullish tweezers but inverted, right? So here we have the bullish tweezer followed by the bearish tweezer. Their wicks look like they've been cut at the same place. Their bodies are pretty similar, and their, in this case, lower wicks could be there, might not, but they could, right? And this just goes to show the story I was telling you guys about, that the candles on live charts, they're not going to look exactly like you want them to look. Oftentimes they're going to have some additional wicks up or down. Their bodies are not going to be like a millimeter precision. Of course they're not, but you get the idea, the basic idea behind them. Just as for every other, we want to see the next candle, the confirmation candle, close below the low of this one, set a stop loss at that place where they've been cut, so to speak, and go in for a sell. Folks, last but not least, 3 black crowds, or however you want to call it, just 3 consecutive bearish candles in a row. The next candle closes below the low of the previous candle,